Today, a spotlight on Thomastown, postcode 3074. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, I had quite a few people ask about other postcodes following my recent Spotlight edition, so today I'm going to talk about another one which several people asked me to analyse. And before I start, I just need to remind you, of course, that this analysis is based on current information. It may change, and very importantly, this information is not financial advice, and this should not be taken as such at all. We're just looking at our data and the currently available information, which will change down the track. We do, of course, pull information from our core market models, and that includes our rolling household surveys, and that information comes in each Tuesday. So the information is relatively up to date. And that allows us to analyse mortgage stress, the price trajectory, the buying and selling intentions, the migration data, and economic data like CPI, wages and employment. We run that through our core market model, and we can look at information at a postcode level, at a regional state level, or indeed all Australia. And we also have different scenarios to take account of different potential future outcomes. And that's how we talk about some of our expectations in terms of what prices may do ahead. So we're looking at Thomastown, postcode 3074, which is a postcode north of Melbourne. It's actually about 17 kilometres north and is approximately 30 minutes north of Melbourne's CBD. It's in the City of Whittlesea, and back in 2016 there was a population of around 20,500. Now, it's a pretty sprawling stretch of ethnically diverse, low-rise, brick-veneer suburban development, stretching right out to the rural-urban fringe. It's got train lines, and it has connections with Australia's manufacturing heartlands. Of course, Ford, when it closed its Broadmeadows plant, took some other way. But there are some new style businesses like CSL and also Ford's Innovation Centre not far away. It's also worth highlighting that public transport's pretty good. There are lots of buses and there are also train stations. But interestingly, there's quite a lot of concern about the hoons that are in the area, particularly along Dalton Road and the High Street. And whilst there are some banks and supermarkets in Thomastown, if you want to do a lot of grocery shopping, you've probably got the road to Epping. By the way, the blocks of land tend to be larger than inner city suburbs, and the prices are a bit more affordable, but you will have to have a car to live here. And whilst the majority of homes were built in the 1970s and 80s, and a number of the original occupants still live there today, this is an area which is undergoing substantial change, and indeed some of those old properties are now being knocked down, and villas and other higher density developments are replacing them. So here are just a few shots down one of the main drags in the area, one of the shopping areas with car parking, another of the relatively major roads. And then if you go off down the side streets, you start seeing these single-storey brick-veneer estates. There's also shops locally as well, like the IGA. And we're starting to see some redevelopment of those original single-storey properties. That said, there are still quite a number which are distinctive. In fact, you could say it gets a bit monotonous. There are also some subdivisions where there are smaller properties on a single block, and also redevelopment where multiple properties have been put on the plot, replacing the original property that was there. It's becoming a bit of a trend, frankly, and this is just one other view of the local shopping area. And you find a weird mix of properties if you drive down some of the streets. Now let's look at properties and units for sale in the postcode. And when I did my research, 28 properties were for sale in Thomastown. And here's a map showing their distribution. So here are some of the properties currently available for sale. an apartment in one of those redevelopment properties, an apartment in one of the older style ones, several more examples of the older style brick-veneer houses for auction, another example of a redeveloped one, and some examples of other houses that were probably one of the original developments. It's interesting to note that there are a couple of private sales there. In other words, people are selling their property direct on the real estate portals without going through an agent. But there is very little price information available really here. Now, if we then switch to the sold properties, 17 properties have sold in the last 8 weeks in the area. Here's a map showing their distribution. And the information is not hugely useful, but there's an apartment at $420,000 last asking price. Remember, the last asking price is not necessarily the agreed settlement price. House last asking price at $770,000. A house at $590,000. Auction without any result there. Last asking price given a range. A house at $570,000 last asking price. A house at $590,000 last asking price. An apartment at $465,000 last asking price. Another house at $520,000. A last asking price house at $650,000. And a last asking price of $500,000 for an apartment. And here's a townhouse at $500,000 last asking price. A slightly more expensive property at $600,000 as a house. And a villa at $400,000, villa of course being another name for multiple developments on the same plot. Now let's look at the current price trends. We'll look at houses first. So back in 2013, the median price was around $380,000. And we saw a small rise of 5.3% in 2014, up to $400,000, a rise of 7.5% in 2015 to $430,000, a significant increase in 2016 at 15.1% and 31.3% in 2017, giving a peak median price of $650,000. Then prices fell by 3.1% in 2018 to $630,000. Fell again by 6.3% to $590,000, rose by 5% in 2020 to $620,000, and has just drifted slightly lower so far year to date to give a current median price of $615,000, down 0.8%. And that gives an average gain over the last decade of 6.3%, or 4.4% corrected for inflation. If I look at units, the story is a little bit similar. In 2013, the median price for a unit was $300,000. Didn't really change in 2014. In 2015, it was up 3.3% to $310,000. It was up 9.7% in 2016, up 29.4% in 2017 to $440,000. Up in 2018 by 4.5% to $460,000. It fell in 2019, down 3.3%, rose 2.2% in 2020, and hasn't moved again, giving a current price through year-to-date 2021 of $455,000. And that gives you an average gain of 5.4% over the duration there, or after inflation 3.5% per annum. But of course, a lot of that growth was in 2016 and 2017, and that's true both for units and for houses. And I would make the point that here we are not seeing prices doubling every 7 years, which of course is that myth that keeps rearing its head. Now, looking at the overall postcode, there are around 68 listings there at the moment, with 40 added in the past month. In May 2019's listings were higher at around 105. And at the moment, 65% are houses, the rest are units, although the drift towards redevelopment and strata is increasing. The vacancy rates are around 3.1% currently, compared with 0.9% in mid-May 2019. And there are around 85 vacancies currently reported, compared with just 22 in 2019. So there is more property being listed and more available for rent. Looking at houses, Investment property gross yields are around 3%. That's a fall from 3.6% last year. The net yield is a lot lower at around 1.5% and is falling. The rents for houses are falling, down around 4% over the past quarter, with a typical rent of around $370 per week for houses. And asking prices for houses are on average up slightly over the last quarter by about 1.3%, with a typical house price of $665,000, but the settlement is tending to be lower, around 6% lower than asking price. And the intention to sell is rising slightly at the moment. Turning to units, there the gross yields are around 3.3%. That's a fall from 5.3% last year. And the net yield is around 2.55% and is falling. That's because quite a few people on long tenancies are now moving on. The rents for houses are rising, but only slightly up 0.3% in the past quarter, with a typical rent of $348 per week for units. Asking prices are about 8% higher over the quarter, with a typical unit price of around $530,000. The average settlement just a bit lower than that, around 3% lower on average. And again, the intention to sell is rising slightly. Now, looking at my stress data, there's around 7,800 households in the postcode, of which 2,200 are borrowing, 3,046 renting, and there are around 2,300 properties for rent, and there are around 1,700 property investors in the area. Overall financial stress is 34%, which is relatively low compared with other postcodes. Looking at our mortgage stress statistics, 1,190 households are in financial stress from a mortgage perspective. That's 53%. That's in cash flow terms. And default rates are around 2%, which is around 43 potentially over the next 12 months. Rental stress is lower at 39%, or 1,192. And property investors are relatively unstressed at 17%. That's lower than the national average, with just 279 of stressed investors feeling the pinch and only 19 severely stressed and looking to sell. So let me come to the price scenarios. So we have three scenarios, of course. The best case is assuming the virus gets under control very quickly, the vaccines get rolled out, the international borders open, and migration internationally starts again quite quickly. The longer-term crunch assumes that things take a lot longer to sort out, and in fact the borders don't open until next year. The second wave scenario assumes that we have more troublesome virus outbreaks, and therefore the economy struggles for a lot longer and the international borders remain shut for longer. And in the best case scenario, over 3 years, we're looking at cumulative growth rates of around 10% for houses, or just 1.9% in the case of the longer-term crunch, or a fall of 6.3% if the virus continues to rage. So if I apply those numbers to the prices, and we go with the best case because that is the one that has the highest probability rating just at the moment, although it's close call now. And in that situation, we go from 615,000 median price for a house up to the end of the year about 628,000, so that's at 1.2%. A 4% rise next year and a 4% rise the following year, giving an estimated potential median price of around 685,000 in 2023. That would put prices just slightly higher than they were back in 2017. But I'd make the point that there are quite a few people holding property that they bought in the early 2000s and they're now looking to trade down, and some of those are looking to sell into the little rise in property that we're seeing. One reason why listings are going up. If I then go to units and look at the scenarios there, we're looking at a 3-year cumulative rise of about 7.7% in our best case scenario, 1.1% in the longer term crunch scenario, or a 5% fall over 3 years if the virus continues to rage longer. And applying our best case scenario to unit prices, the median price goes from around 455,000 up 0.6% by the end of the year to 458,000. In 2022 to 476,000. And in 2023, 491,000. That would put prices just slightly higher than their previous peak. But again, the growth rates are pretty anemic. And that's really the point about this particular suburb. It seems to me that whilst there is some chance of small rises, it's not going to be a substantial capital appreciation over the next few years. And we are seeing some people thinking that they might sell into the expected broad momentum in the housing sector around Melbourne, although in this postcode there really isn't that much evidence at the moment of anything very substantial. And because those rental yields are relatively low and falling, property investment probably doesn't make a whole lot of sense. But buying for owner occupation in this sort of postcode, assuming you can deal with hoons, is probably reasonably attractive. It's reasonably accessible to the city. Prices have not risen dramatically and are probably not likely to. But on the other hand, the blocks are quite large, and you will potentially be competing with developers who are looking to knock down those 70s and 80s single-story veneer properties and establishing instead multiple units, either units or indeed villas, to capitalise on the value of the site. And I guess that underscores the critical point, which is that really in this area, most of the value of the property is actually the site, not the building on the site. So there you are, a quick summary of Thomastown. Hope that was useful. And if you have other postcodes that you would like me to analyse, just make a comment below. And if you want a one-to-one conversation about a particular suburb, you can always contact me about our one-to-one service, where we can do a deep dive on an individual basis and go into even more detail than this high-level summary. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.